Stanbic Bank has recorded a 13.7 billion profit after tax. Commendable. I'll be having a conversation with Joshua Oigara, the chief executive here in Kenya and South Sudan, to unpack the numbers. Let's get straight to the conversation. Joshua, welcome to the show.
No, thank you.
Let's get to this now first. Congratulations, because last year you had predicted at about close to 14% increase, and now I've seen you've hit the 13, which is very good, 12.8, and I think that was commendable. First of all, we must give you your flowers.
I mean, yes.
And I wanted to ask you first, what are the drivers behind this, and looking at the performance and how you're feeling about it?
So first, thank you for hosting me. It's been a long time to have these conversations.
Yeah.
But I would say maybe just from the beginning, last year was largely a more characterized difficult year for a lot of our markets.
Yeah.
Not just Kenya, but global headwinds in our market. Kenya saw a difficult area. If you look at just your macroeconomics areas, your inflation started coming down.
Yeah.
We had pivoted interest rates last year, liquidity challenges in terms of money markets in Kenya. Obviously, we also did have the Gen Z challenges and demonstrations last year.
Yeah.
And generally, the purchasing power for our clients in the industry across Kenya, that kind of basket of goods kind of dropped.
Yeah.
And it's on that basis that when you see a 13.7 or 14% growth, it's very commendable in terms of the resilience of our business. So main two drivers, protecting our earning portfolio in terms of our client activities. We still saw 6-7% growth in activities for our clients.
Yeah.
And then number two, we had resizing of our loan portfolio. So we saw a contraction of our loan portfolio by 12%. Most of it was largely on the foreign currency reset of our exchange rates. Remember, we had a significant incident in February.
Absolutely.
And it has remained steady over time.
Yeah.
And then finally, we are more judicious in how we managed our credit portfolio and originating new facilities during the year. So you look at our cost of risk, we are one of the lowest cost of risk in the market, share 1.1, 1.2%.
Wow. And this is very commendable. You know, I also wanted to refer to something you said. You had outlined plans to strengthen corporate banking, expand SME offerings, and deepen digital transformation. What are the progress you've done in these areas?
So the year, the financial sector and banking sector is in the center of really transitioning and moving forward an economy. There is no center as connected to the intensity of our fabric of our nation like the banking sector. So every single fast seed of capital you provide for businesses, for families, entrepreneurs, lifts jobs, creates homes, addresses housing, healthcare, all the needs. And because we don't have a very strong, very, very strong, private equity yet in our market. So across our segments, I love that our large clients, we call them corporate and investment banking clients, have continued to push the limits in terms of the business they do. And last year we onboarded a lot of new clients in our organization, despite the difficulties. I was very impressed with the new Unlocking New Horizons campaign we launched last year for our small and medium enterprises, who were the fabric of our nation last year. And we saw a lot of clients coming on stream, growing that. They're traders, they are in agriculture, they're entrepreneurs, they're supplying housing, healthcare. We saw that running very well. And finally, actually not finally, but we had two new businesses. So we launched our private banking business, which was recognized as the best private bank by Euromoney in the market. And then finally, we launched asset management business last year, which by the end of last year and as at now, is almost reaching the $4 billion mark in terms of assets. So that was an exciting year overall for 2024.
Excellent, excellent, lovely. You had some very exciting news to your shareholders, and I think this is commendable. Dividend growth, of course, shareholder returns. I think I had some numbers with it. I think your dividend now increased by 35.1% to 20.74, which is really, I had some of the shareholders really commending me for this. And I don't know what message you want to send to your investors and even potential ones. Do you foresee yourself maintaining this particular dividend trend, which already you had promised and you've done?
Yeah, we're very consistent in the way. So in terms of the continuum of how we see shareholders return, largely it's a fundamental ambition that the board we have over the years. And when you look at our 60% dividend payout, it's something actually we're building a consistency around that frame. So remember, post-COVID, we had some kind of resizing around where that number should be. But generally, we never moved away from setting the benchmark. So if our shareholders, and I must thank their support. So we're also changing the kind of capital structure on how we look at our balance sheet over year on year. So we're bringing in more tier 2 capital into our balance sheet structure, which means you are able to be flexible in terms of how back we give our shareholders. But I must say that this was perhaps the most significant increase in our dividend payouts ever in the last 3-4 years.
Let's get to the challenges. And I wanted to start with your market in South Sudan.
Correct.
We are looking at it. We are seeing a bit of depreciation of their currency, a little bit of some turmoil there. What are you observing?
One of the things I get very excited about to speak is around a different lens of how you construct countries. So that architecture, Kenya has been an independent country for more than 6 years. And sometimes we make an assumption that countries have the same roadmap on how they come out and build themselves. In South Sudan, post-independence, in 2007, and obviously the elections in 2010, 2011, it's not been a long time. So this is, you're talking about the second decade. So the construction of the massive pillars of growth, largely the economy is dependent on oil exports, 95% of the economy. And then there was a disruption last year because of the challenges we have in Sudan. So that has been a fundamental flaw. So hyperinflationary element has come into the market in South Sudan. But let me say that we navigate complex countries as Stanbic. We've been there for a long time. Actually, Stanbic has been the first anchor bank for the government of South Sudan, even before independence. So, but last year was particularly difficult, if I look at it this way. We are hopeful that now the oil exports are likely to open themselves up this year. We should be able to see, can I say, not resuming to normalcy, but an improved market conditions. So our businesses went down last year more than 60%, largely because of oil exports were not running. And that was a massive issue that we had before. And then when that had happened, economic activity naturally just comes down. But we are optimistic that, what we see in that market is to diversify the size of the economy.
Okay, lovely. I'll come to the Kenyan market, and I just was looking at the numbers. I love the word that you like using, navigating economic cycles with your people and supporting clients through difficult times. That's the word you used last in our previous time. And I'm curious to know how that has been going, but I want you to center on your NPLs. There's a slight rising of the NPLs, but when I look at your rate, it's still within standard market rate. So I wanted to ask you, how are you managing this credit risk while maintaining profitability?
So let me step back. When I look at the silhouette on how you see enterprise and markets, sometimes the mirage we have as business and clients and also as investors is it remains steady. It's actually not true. There's a lot of mini shocks. If you look at them very closely to the lens, there's always there every singular day. The question is, how do you maneuver your business in that context? It could be an interest rate shock. It could be a pricing issue. It could be a currency challenge. It could be an issue around your global geopolitics. It could be just around your flooding, your elections issues. That is the nature we have. And my view, what I've seen in the last decade, the more we are prepared, the more we are able to take opportunity of that. Stability is not something we see in the last decade. So if I talk about, the non-performing loss ratios, it increased largely because our loan book reduced. And that was because you look at that area, that's the material area we saw. And of the 12% reduction, actually, 8% of that was largely foreign currency resetting of exchange rates. Because remember, 40% of our portfolio is foreign currency. 40%. Actually, in last year, it was more than 45%. So today, it's now come down to, at that time it was 50%. So now we've changed the balance sheet to say now 65% of portfolio is local currency. So that's the biggest change. And number two, you look at the cost of risk. So our NPL ratio around 10% is still quite lower compared to where we see in the market. In fact, I always ask my teams, are we taking enough risk for the portfolio, for the markets where we are? Because look at the cost of risk. Our target is 2%. We're at 1.17, 1.2. So what is happening with these 80 basis points? And that is largely SME businesses we want to be able to deal with, local corporates we want to be able to deal with and support them, and largely the consumer market in Kenya, where we need to be able to deal with as well going forward. So I am happy with that moment. But our long-term ambition is still below single digits for non-performing loan ratio.
Still part of this, you've mentioned things to do with interest rates. And CBK, I don't know whether we can now, it's hard to actually see whether they're predictable or what's happening, but of course the interest rates have been coming down. And I want to ask you from your end, when you look at the CBR and what they're saying, I think they lowered it now to 10.75%. And with the hope to stimulate really the market, the borrowing and all that, especially on the private sector side. How does this change impact your lending, especially strategy? How does that impact you?
Last year was a year we saw a nosedive on credit growth of the private sector for the first time I would say, since COVID, post-COVID. So if you look at from 2021, so minus 1.4% deceleration of credit in the market.
Yes.
And that's a significant step,
Yes.
which was in the wrong direction.
Yeah.
Because you need credit to be able to accelerate growth, to see GDP expansion. Now, there are many reasons for it. But if I also summarize, we saw industry loans come down. Obviously, with heightened interest rates, clients find it difficult to be able to continue their activities.
Yeah.
Last year we saw interest rates go as high as 24%. 24%. That's a massive interest. I saw them last like that, I think, in 2011, right? So that's a massive peak. So we saw repayments. But in terms of average loans last year for our business, they grew up 13%. That's a very good measure, average.
Okay.
So if you compare average 2023, average 2024, when you look at closing balance in December, as their finance people look at it, that is a closing balance.
Yeah.
Correct? And then there are short-term facilities, some repayments. So this year, I am much more optimistic, actually, that as you expand new sectors of the economy. So housing was affected last year. Export was affected last year.
Yeah.
Manufacturing was affected last year. Trade. So all those areas, what did very well? Agriculture did very well last year, you remember?
Yeah.
And tourism.
Yeah.
Those were fantastic areas of the economy. Education segment, healthcare sectors. So we're actually confident that today we should see this year at 10%. So our ambition is to grow our loan with between 14 to 16% this year.
Okay.
Despite coming a minus 12%. So it's the new sectors that you see in the economy. And number two also, why do I feel confident? So as rates, you ask about the rates coming down, right? The direction is the right one. So there's a question mark around, is it are the right prices right or not? My view is there's a lag effect. Takes a bit longer between when central bank adjusts central bank rates. Banks give a notice to clients, which is always 30 days, and then prices take action.
Okay.
You get me? So that's what I would say, like there's almost a 30-day, 45-day lag.
Right. Okay.
And all of us, including Stanbic, have reduced our rates to where we are today. I think we have a new rates now from 19th of March.
All right.
So with lower rates, today now I would say at 15.5% as a lending rate for the base rate. That is much, much more affordable for clients than where they were last year. And I'm starting seeing activity. I'm actually excited to see the ambition of activity and churn in January and February this year.
Ngozi yako ina glow. Nilijipaka mafuta leo asubuhi nikikam, lakini skin yangu ishaparara and it looks so dull.
Sis, see, it's the new Nice and Lovely Lemon Extract Body Lotion. Hiyo ndo secret yangu to a moisturized and bright skin. Usimix.
New Nice and Lovely Lemon Lotion, enriched with vitamin C and sunflower seed oil for 48-hour nourishing glow and brighter skin. Try Nice and Lovely Lemon Lotion today.
This new year, discover something new every day on your StarTimes decoder. Buy an aerial decoder plus 1 month free classic bouquet subscription to enjoy the magic of African stories on ST Swahili, AMC Movies, and ST Nollywood. Tales of adventure that take you far on Bliss TV, ST Kung Fu, Z Cinema, and Nat Geo. Or a dish decoder plus 1 month free super bouquet subscription to watch heartwarming dramas that bring you closer.
Do you want to be my wife?
Yes, David. I want to marry you.
Exciting kids shows to keep the little ones entertained.
You got it, dude.
Experience the thrill of live sports on La Liga and Bundesliga. For every mood, for every moment. StarTimes. Enjoy digital life.
Daily Nuggets with ZD Money Market Fund. Taking control of your finances starts with a plan. Pataka kitu kila siku na ZD Money Market Fund powered by M-Pesa. Start investing directly from your M-Pesa. Opt in via M-Pesa app or dial *334#.
Grow your money daily with ZD Money Market Fund, powered by M-Pesa. Opt in on your M-Pesa app or dial *334# today. Terms and conditions apply.
Oh, that's good.
Yeah.
You're already seeing some exciting activity. That's good. You know, you're a captain in this industry and still on Malta Central Bank. They talked about their cash reserves, CRR, and all that. And definitely some of the banks, maybe some of the, I don't want to categorize them, may probably need to get into conversations, because some people are even thinking mergers may end up having conversations like that. And I'm speaking to you based on the fact that you have a bird's eye view.
Correct.
What are you observing with this particular regulations coming out from CBK? What would be your sentiment on that?
I mean, if there's one thing I value that this year and the last year, we have a very strong anchor in Dr. Kamautuga and the entire team at the Central Bank. I mean, there's also a lot of engagement around what exactly is driving, just like the conversation we had earlier on the minimum capital or the raising of capital for banks from last year. There's been a lot of discussions that are going on. That I love that engagement. In reality, we like you to see more and more consolidation of the financial sector. So remember, where are we as a country? And we have to always remember we must punch beyond our capabilities across the continent.
Okay.
So we can say many things. You know, it's one thing to say, if you want to play on the Champions League, you can't always be on the league in Dogo. That's the reality of us. And this is a macro issue. It's also an industry issue. So who are the big brothers when you think about what is happening up north in Egypt? What is happening on the west with our friends and brothers and sisters in Nigeria? And what's going on in our big economies like South Africa? So these 4 quadrants, we have to meet our place in the growth of the continent. And it's either you do it today or at the end of the day, somebody else somewhere else in the world will deliver that work.
All right. And I want to finalize on the CBK. They highlighted that banks must now lower the rates in line with the risk-based pricing.
Correct.
And I want you to focus on the risk-based pricing.
So I would say, in my view, and this has been the best way to paraphrase it is looking at it like a continuum of sorts.
Okay.
You really have a, can I say, like one magic bullet to have a scientific delivery of a rate for a client. Yeah, even to the closest standard deviation, we wanted to say it. So there's an element of science, but there's an element of art. Correct?
Yeah.
So what we have in our view as Stanbic is we have our rates, I've applied this with price for the last 2 years.
Yeah.
So it gives you a kind of your base construct for your rate, and then there's a margin where the customer is on the credit risk, because all clients are not the same.
Okay.
There are clients who have a very good rate, we call them prime, and then the clients who are coming into the ecosystem of lending, who are new to bank.
Yeah.
Naturally, they are all different.
Okay.
And each of them gets a rate. So where the challenge has always been is how quick are we able to adjust the base rate? This is where the concern has been. And we've seen some lessons in the last 2 years.
Yeah.
Sometimes there are facilities that are very short term, which means below 3 months or below 6 months. And there are facilities that are long term, like 15-year mortgages. We are offering 20-year mortgages. So think about us locking liquidity for 20 years. Correct? And that's where, for me, the debate has been, do we have a good instrument? So I am happy that there are lessons that we've learned. And it will be great in this moment. Actually, this is an opportune time for us to catapult ourselves and use that lessons to make amendments. The biggest worry for me is that if we know that the tool is blunt, we are not able to pass through the benefits to clients. I mean, I'll give you our own example. So it's a lot of when the interests were going up very strongly and the central bank was increasing central bank rate, we were not able to act on our clients' prices. If I look at most of last year, the earliest we were able to make a change was July. 6 months later.
It would have had a great impact on.
Huge impact on our margin, huge impact on our incomes. Could we have acted much faster? Yes, but we have a model. And that model is what we're working on. So we want to kind of sharpen the instrument that we have. Correct?
Yeah.
And sometimes I say in my own language that you need to distinguish the signal from the noise. Why we are getting a lot of this conversation is noise because people don't get to see the details of the models that you have. Remember, every single client we have their own rate. We don't have an omnibus rate for every single individual. You got a base, you got a margin. There are no two clients who are the same. So that's, for me, I salute the work being done by the central bank, just to clarify and to support. And what we are pushing for is to have a faster response. And then there's also questions which you have to address. So when you are raising your rates, there's the consumer protection guidelines say you must give a 30-day notice. But when you are reducing the rates, which may look like it's a benefit to clients, do we need the 30 days? You see, the framers of the legal construct didn't reflect about those two moves. It's a going up move, which is seen as punitive for clients. That period, the same as if you're... So if I change my rates today, should I just announce that they're starting tomorrow? Or should I wait for 30 days? The regulations are very clear. It's a 30-day notice.
So what you're saying is that there are conversations to have. Sustainability is something I must always bring in ESG initiatives.
Correct.
And you had committed to climate resilience, infrastructure finance, renewable energy funding, quite a number of things in terms of commitments, especially on the solar financing as well. How is this going?
I mean, I'm excited that you remember those priorities.
Yes,
Year on year.
Yes.
Despite what is happening on the global north.
Yes. I know, because that's a factor.
Conversations where I've seen colleagues, CEOs say, okay, we're not sure about those commitments.
Yes.
We remain robustly, to confirm our ambitions around just energy transition and infrastructure. More you need it, actually. If you think about our market, doubling up the capacity for the superhighways, either to Mombasa or into Malaba, you need to do that for our country. There is no other way around it. And that requires energy investment, infrastructure investment. Financial inclusions, last year we crossed over more than 100,000 clients screened for new lending, for the informal segment, which we never had before. Target is to reach 5 million by 2027. If I think about the climate resilience and funding, we are able to screen today, our targets to achieve 10% of our green lending portfolio last year. So last year we screened closer to 300 clients, 100% on ESG. And that for us is the bare minimum of what we do to be able to support those kind of clients. But also we are pushing out the clean energy transition, because with energy, you're able to provide a lot of sustainability for our clients as they move forward. And then finally, it's about job creation and enterprise development. If there's one area we have to invest much more as a nation and as a bank, is about opportunities for SMEs, then create 2 or 3 jobs. So if I've got 100,000 of those SMEs, I can assure you 3 jobs or 4 jobs is 400,000 jobs. And that's what our nation requires by far, especially in this decade.
All right. I'll be checking you out. I'd like you to end by giving us an outlook for 2025 and, of course, a final word as well to your customers and shareholders.
I mean, I'm always excited that the trading bell is very much connected across the entire corners of the planet.
Thank you.
Yeah. And the winds are always blowing, but we must remain focused on the portfolio where we are growing as a business.
Absolutely.
So let me say about 2025. So I acknowledge and I want to speak well to our clients. It's been a very difficult year last year. But I'm very optimistic that a lot of the wins that we saw, the headwinds, are largely, today being able to converge into a moment of progress. So if you look at interest rates today, they're tapering down. If you look at exchange rate, really very steady for a long time. We salute the central bank and the team with the industry. If you look at areas like inflation, we've had the lowest inflation we've seen for a very, very long time. If you see foreign currency reserves at the central bank, and we may have many questions, but I always look at numbers gives you, if you really want to understand how you want to path for flight, you need to look at the elements of the data points. Look at the flight plan. Correct? And therefore it is showing that the momentum is moving. Now, cost was a big issue last year, so for credits, and that is coming down. So we like to see more of activities for our clients. So we are posturing for stronger growth in credit. Industry normally grows at 10%. Last year we grew at minus 1.4%. But if you remove foreign currency contraction because of the resetting of the currency, growth was 4%. So it wasn't almost zero, it was 4%. So how can you get that to 10%? And with more credit, you bring in more activity and more growth. And then the regions within Uganda, within DRC, all these areas are potential opportunities for us to be able to build. I'm a big rooter for Kenyan businesses to be able to build their business across the region. But that's a natural market for us, 450 million people compared to around 55 million in Kenya. So that's the second point I'll be able to say. And largely, we worry so much about what is the downside that we'll see. So obviously the changes in the posture globally in North America, if you talk about particularly the Trumpism that you see in the United States, you're also seeing that in the Eurozone area, in Germany, for instance, in Italy and France. My view is that markets like us have an opportunity, especially being in Kenya. There is a gap for development financing for areas like healthcare, the challenges you're seeing around the executive orders, around healthcare, USAID funding, and all those international programs. That's a gap. But perhaps it's an opportunity for us to be able to raise our stakes and say, can we in private sector and government do something to support those areas? It's time to stand for ourselves, in my view. Yet areas like AGOA gives you opportunities for us to say, can we do something as a nation? So whereas we may be systematically worried about global effect, my summary is, if there are universal changes that affect every single country in the world, those will worry us. If they are targeted, specific country to country, It's the US vis-a-vis Mexico, the US vis-a-vis Canada, US vis-a-vis China. Those are not the issues. We can speak about them, but they don't have a direct material impact for an economy like ours in Kenya.
Wow. Joshua, always optimistic. Thank you so much for your time.
I appreciate it. Thank you for having me.
Excellent. There you have it, Joshua Oigara. And quite bullish, if I may use that word, that, listen, once we have stabilized our ground, we are ready to fly. Thank you so much for your time once again here on the Trading Well. That was Stanbic, just analyzing how they performed in the year 2024. And we look forward to the outlook they've predicted as well, 2025. I leave you now with the markets.